This is Anchor Your Retirement with Barb Gulland from Safe Harbor Financial Planning Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Barb Gulland provides her clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Anchor Your Retirement with Barb Gulland.
Welcome to the Anchor Your Retirement podcast. I'm your host, Barb Gulland, but Tony Shore is nowhere to be found today. So I'm talking to my friend, Mariann Montagne, who is a portfolio manager with Gradient Investments. Hey, Mariann, how you doing?
I'm doing great, Barb. I'm so glad we can do this today.
Me too. It's about time we had a girls' night in the podcast. You know what I mean?
That's right.
I have like a million questions to bombard you with today on all kinds of different topics. So I hope you're geared up and ready to go.
I'm ready.
All right. Let's start out with something that is near and dear to both of us and something that we've both had to deal with through our lives. Let's talk about the pay gap between women and men.
Well, yeah, the pay gap has existed for decades and decades. And just as an example, if you started working back in 1975, women got paid a discount of 37%. That's pretty horrible. If you started working in 1990, the pay gap was 25%. Horrible. Mm-hmm. In 2005, you started working, the pay gap was 18%. And I can't believe if you fast forward to this decade, the amount is about 16%. I never would have believed back when I started that we'd still have this ridiculous pay gap.
No, I mean, we've made progress, but we still aren't there. And there's various reasons for the pay gap, which could be a whole show in and of itself.
Oh, yeah.
But, I know that you share the same passion I do for making sure that women are empowered financially and that they understand how their money works, why they need to make it work for them, and how we can be better at it. We outlive men and we make less, in many circumstances. And then not only from the pay gap perspective, but a lot of women take those first years off when their kiddos are little to be mom, and then they miss out on that time value interest compounding that can really make a difference in their retirement accounts.
Right. But again, going just to the salaries, the hiring managers will ask, well, how much did you make at your last job? And particularly if you took some time off for your family, that really dings into you. And now it's illegal in more than 16 states for them to ask that question. So if someone is asked the question, they can diffuse it by saying, well, I understand your salary range for this position is X to X. And with my qualifications, I think I should be at the higher end of that range, and just deflect that whole idea about what you were making in the past because it's irrelevant.
Yeah, we need to learn to advocate for ourselves a little bit.
Yeah, because what happens is the average male college graduate by his early 40s earns up to 55% more than the average college graduate who is female. And that's just ridiculous. There's no basis for that.
Especially since more women are graduating college than men are at this point.
They are. But, I'm one of those women who took years off when my kids were young to be at home. And I was fortunate enough that my previous boss rehired me years later and, said, we missed you, Mariann, and, here's your desk. And I got back on that bike and started pedaling hard. And, it all worked out. I've been in the business for over 30 years now. And, through my experiences, I like to share some of these insights with other women.
Yep, I've gotten to attend a lot of events with you over the years, and it has been a blast. It just to talk to peers in the industry has been a tremendous blessing, but to learn from other women who have really carved out the path beforehand is something that doesn't happen very often. And I'm very grateful to be affiliated with a company that really does focus so much on making sure that there's a good representation of women in the industry as well, because I think that that's how we help people overall in the future. But I don't want to just talk about women in this podcast because it's very seldom that I get a chance to have you all to myself.
Okay.
So I'm going to take advantage of that today. Let's talk a little. You're okay with me throwing questions at you from all over the place. Okay. All right. One of the things that a lot of my clients talk to me about, first of all, when I get them convinced that the currency system is in fact not going to hell in a handbasket, they start to talk to me about crypto and Bitcoin and that kind of thing. So I'm just going to throw a general question out there. What are your thoughts on Bitcoin and cryptocurrency?
Okay. So first of all, there's over 200 cryptocurrencies out there. And just as there were over 200 automobile companies back in the early 1900s, we think most of these currencies are going away. And I don't know if they can be acquired exactly because it isn't exactly assets, hard, manufacturing products or anything. I think it's going to come back down to maybe 2 or 3 leading cryptocurrencies. What we prefer to invest in is not cryptocurrencies, but blockchain. And by blockchain, we mean the systems behind it, the global systems of moving money digitally. And you can be invested. Gradient actually has a strategy called the Digital Discovery Strategy. It's done extraordinarily well in 2023. And that includes companies like Microsoft and IBM. So they're companies that we know who the managers are, as opposed to cryptos. There's great mystery around that. You do not see companies like IBM and Microsoft disappearing over the weekend, as you've seen with cryptos. So we think the blockchain is the way to invest.
Do you think we're ever going to see cryptocurrency regulated, or how long do you think it's going to take before it becomes a regulated currency?
I think it's going to take quite a while because most Congress people have no idea what it is in the first place and don't know who to rely on for information. It's amazing to me, before Sam Bankman-Fried blew up his company, which was based in the Bahamas, in epic fashion, little clues like right in front of your face. They're in the Bahamas. Like, why? Sunny place for shady people.
I've never heard that one.
Oh, yeah. The Cayman Islands, other places like that. So up until that point, everyone loved cryptocurrencies for the fact that it was not regulated, that there was no government interference, that there was no fingers of any regulators around them. And then once that blew up, boy, do they want regulation, and they want everything up, visible. And yet the whole basis for crypto has been, to keep transactions hidden from authorities. So I'm not optimistic about any type of regulation anytime soon.
That makes sense. Let's go to something that's been a little bit more timely in the news. Let's look at the conflict in the Middle East.
Sure.
How much do you think that is going to impact investments through the end of the year? We just came off of an extended ceasefire and the fighting has ramped up again. Yeah. We're recording this about a week before the podcast is probably going to be published. So hopefully we'll be in another ceasefire by the time this goes live. But what are your thoughts on resolution with that and how it's going to affect the markets through the end of the year and maybe longer term?
Okay. Well, first thing I would say is gold has responded dramatically well since the invasion of Israel by the Hamas. It's been up 13% just since October 5th. So, and we're recording this on December 8th. So, in about 2 months' time, it's gone up about 13%. And that is because gold is often considered a safe harbor, a safe haven in times of geopolitical strife. And the similar occurred when Russia went into Ukraine. So gold has also been responding to lower interest rates. I have to throw that in. But in terms of the war, what is my outlook for any kind of truce, long-lasting truce? This is an area of conflict for 2,000 years or better. And so I would not put money on any truces, long lasting, short lasting, anything for any period of time. It's just a huge tragedy to the individuals over there.
It really is. And you mentioned interest rates coming down. Well, treasuries are hovering right around 4%. Might have even gotten through that. They've been hovering right at 4, I think, lately.
Yeah.
But where do you see that going? And if people are looking for better rates of return than what they can get in treasuries, thoughts there?
Okay, so let's look back on the past 12 months or so, and we knew that the government was going to raise interest rates in response to inflation. Inflation was super high, almost 9%, and they wanted to rein in the economy and rein in demand for expansion by various entities around the country. So I'm going to look back now. Well, interest rates went up to as much as 5% for 10-year treasuries. That's considered the benchmark on which most other interest rates are adjusted. So I'm going to look back to July 30th of 2021. So a little more than 2 years ago. And you could only get 1.24% on this high quality government issue. And, if you were someone who had to pay interest, that was sweet. You could get low interest loans and go for it. But
we all enjoyed those 2% and 3% mortgages, didn't we?
Oh, yeah, we sure did. But if you were someone on a fixed income and you had a set number of dollars to invest in, that safety type assets, you were getting dang little money for doing, making a 10-year commitment to a U.S. Treasury. Okay, so fast forward from 1.24%, we're now about 4.37% at the end of November. And rates have been coming down for the last several weeks since we hit that 5% mark. But to get more income, again, back in July 30 of 2021, you could go into investment grade bonds. So these are blue chip companies, common names that we all know and trust. And you would get a grand total of 1.94% back then. Today, you get 5.65.
That's not bad.
No, and to be a recent retiree, that's not a bad option. Go into investment grade bonds. The third level of risk is your high yield bonds, sometimes called junk bonds. And back then, you could get a whopping 4% interest rate on high yield bonds. Today, you can get 8.3% on those same junk bonds or high yield bonds. So here's the strategy we recommend for people who are looking for the higher income. We have an absolute yield strategy. And we're not saying take all of your money and do this, but if there's a gap in your income between Social Security and maybe some real estate holdings you have or some other business that provides you some income, take a portion of your portfolio and put it into this strategy, which incorporates 10 different asset classes. And we're talking about preferred stocks. We're talking about some covered calls. We're talking about some high yield U.S. bonds, some overseas emerging market bonds. Right now, overseas, that group is paying 3% more than the government bonds in the U.S. So,
Wow.
why not get a 7% from emerging markets? Just watch out that you don't have a Israeli bond in there.
Yeah, no
Uh,
kidding.
Yep. So
Yeah.
there's a whole host of them. You blend them together and you can get a good 7.2% yield these days. It's a low cost way of diversifying because we use exchange traded funds. And as you know, these are pools of companies, stocks or bonds, that answer to certain criteria. And in our case, it's high yield. It might be also REITs.
Mhm.
It might be some senior loans, which means they have some collateral against them. So you
Okay.
put them all together and you end up with about as much volatility as the US stock market. You end up with something like a fruit tree or maybe a money tree in which you can take those dollars every month and quarter. Some pay monthly, some pay quarterly,
Mhm.
and get that 7.2% yield. Your tree's not going to grow much. So that's the trade off.
But
But
you get a lot of fruit.
you get a lot of fruit, a lot of tasty fruit. And, maybe you only need this for a few years,
Mhm.
maybe not. But over the course of time, we expect it to return a little bit more money to you than where you started out. I think right now is an opportune time to do this because you have interest rate, what we call spreads, the difference between this high yield category and government bonds being pretty good, around the 400 basis points or 4 percentage points.
That
And
is pretty significant.
yeah. Yeah. I mean, optimally, you would buy when the spread is 700 basis points, but usually that's when people are asking their advisors, shouldn't I be heading toward the exits? Shouldn't I be getting out of the stock market? They get all freaked out. And so people tend not to buy when the spreads are that wide. But that's really the optimal time to buy. And then, the optimal time for you to be, the individual to be selling this is when you no longer need this type of income. Again, it would be nice if you could sell when the spreads were down to, say, 100 basis points. Or the normal
Yeah.
spread is 300 to 700, but it goes above and below that. So, you've got to do what's right for you, what's going to help you to sleep well at night. And I think the absolute yield strategy is very important and very timely right now.
Yeah, we have several clients in the absolute yield portfolio, and it has done very well for them over time and has, kept their income where it needed to be. We have no complaints about that there.
Lovely.
Yes, yes. All right. So, did you bring your crystal ball with you?
I did.
Is it cracked or are we good?
It's a little murky. But, people ask us all the time, what's the market going to do?
Yeah.
And
Talk to me about 2024 a little bit.
yeah, well, let's go back for a second and talk about 2022. When the
Do
market
we
was
have
down
to?
18%, our crystal ball was rotten on that year because we
So
thought
was
the market.
everybody else's.
Yeah, well, we thought it was going to be up a little bit, and that did not work at all. And then in 2023 so far, we have a market that's up 21%. Now, we would never have guessed at 21% either. These swings are well
Pretty big.
pretty big. Yeah.
Yeah, they're outside the normal ranges of things.
They are outside the normal ranges. And let me just talk about 2023 for a minute here, because this is really outside the normal ranges. You have 7 stocks now that account for about 50% of the NASDAQ. And the NASDAQ tends to be large cap technology type companies. And to have 7 companies out of the NASDAQ accounting for 50% is just wild. I mean, that's just way, way beyond anyone's ever experience.
It really is. For our listeners that don't understand how the NASDAQ is built, how many stocks are we normally looking at that
About
are
100.
contributing? Okay.
There's
So,
about 100. But
right.
these 7 represent 50%.
So much of the growth, right?
So much. And if you look at the broader market, the S&P 500, which we direct most people to, they represent about 30% of the S&P 500. So 7 companies out of 500 represent 30% of that broad market index.
We definitely have tails wagging the dog this year, don't we?
Yeah. Yeah. And there is no portfolio manager I know of who would tell all their clients to put all their money into 7 stocks. That just doesn't answer the need for diversification across different sectors of the economy, across different companies. It's way too much reliance and way too much risk to be in 7 companies.
Very true. Very true.
Your clients could probably not sleep well at night knowing that they were only in 7 stocks. But these magnificent 7, as they're calling them, are up, as of the end of November, about 80% year to date. And the rest of the 493 stocks in the S&P 500 are up only about 3% as of November 30th year to date. So it's to say the market is up 21%, you'd have to have everything in the S&P 500 in there in order to make that work. And we don't do that. We don't buy just an index.
No. But that's why we utilize somebody like Gradient Investments as a money manager, because there's an actual thought process into what goes on. It's not just an arbitrary, it's not an index fund, like you said.
No. And we're also trying to customize for every person's needs. So as we were talking about the need for income, we would always have a piece of that for them. And we would never put somebody who needs income into 7 stocks that do not provide income. So that's my background. But looking forward, you asked about 2024.
Yeah. So where are we headed in 2024? That would be a great thing to know.
Well, first of all, we're coming off a period of time with strong economic growth. The consumer spending has held up very, very well into the second half of this year. And we think that's going to carry over into next year. The issue is because of some big gains and some small number of names, we think there might be some tumult, some volatility in the first half of the year. But
that makes sense.
Putting on my, guru kind of hat, I would say we're probably going to be up for the full year next year about 8 to 12%. So kind of zero in on the middle of that and say about 10%.
Well, and it is an election year, and we know everybody in DC wants to keep their jobs.
Well, they do. They do. And what most people don't realize is the party, the incumbent party, that is, so in this year, the Democrats, they keep their jobs, the incumbents do, if the economy is doing well 90 days before the election. So take a look 90 days before November 3rd, and then you'll get an idea of who's going to get elected. But regardless of which party gets elected, and we've gone back about 100 years and found that the markets have gone up every administration, Democrat or Republican. Typically people's expectation or people are delusioned by who's been running the company or a country for the last 4 years, and they throw the bums out and they get a new administration in from the other party. And as to the portfolios, it really doesn't matter, because the market just responds to corporate earnings, corporate revenue growth, expectations for the companies, and not the political rhetoric.
Very, very true. Well, Mariann, I know that your time is precious, and I am grateful for the time we spent together today, but I know you've got other things to get to. We did have an amazing slideshow that you put together that, thanks to the glitches of the miracles of technology, we couldn't show you today. But if you are interested in getting a copy of that slideshow, we would love to send it to you. If you would like to do that, please reach out to us. Call area code 913-553-6222, or go to anchoryourretirement.com and fill out that contact form so that we can email that slideshow to you and give you the opportunity to visit with us one-on-one for a complimentary consultation so that you can figure out whether your crystal ball for 2024 is correct or whether we need to make some course corrections in your current investment strategies and portfolios. Mariann, it has been a delight to visit with you today.
Oh, it's always a delight to spend time with you, Barb.
Yes, I hope I get to see you in person sometime real soon.
Me too.
All right. Well, that's it for us today on the Anchor Your Retirement podcast, and we'll see you next week.
Thank you for listening to Anchor Your Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Barb Gullen at Safe Harbor Financial Planning Group. Call 913-553-6222 or visit them online at anchoryourretirement.com.
Advisory services are offered through Safe Harbor Financial Planning Group, LLC, a registered investment advisor in the state of Kansas. All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a